Directing your money involves assigning every dollar a specific purpose before it leaves your bank account. The 50-30-20 framework is a structural method for organizing your take-home pay to ensure essential costs are met, lifestyle choices remain sustainable, and your financial future is actively built. By viewing your income through these three distinct categories, you transition from reactive spending to intentional capital management. Core components of the 50-30-20 framework. The framework divides your net income, the amount that actually hits your bank account after taxes and employer-sponsored health insurance, into three functional buckets. This method provides a clear boundary for spending while prioritizing long-term stability. 50% for needs. Needs represent your non-negotiable obligations. These are the expenses required to maintain your health, safety, and ability to work. If you stopped paying these, your life would fundamentally change for the worse. Common examples include your rent or mortgage payments, basic utilities like electricity, water, heat, groceries, transportation costs to get to work, and minimum debt payments. If your needs total to more than 50% of your take-home pay, you're likely overextended in housing or transportation, leaving you vulnerable to financial shocks. 30% for wants. Wants are the choices you make to improve your quality of life, but are not strictly necessary for survival. This category includes dining out, streaming subscriptions, hobbies, equipment, travel, and upgraded clothing. This bucket is often most difficult to track because wants frequently masquerade as needs. For example, while food is a need, $75 dinner at a restaurant is a want. Distinguishing between the two is a requirement for maintaining this balance. 20% for future. The final 20% reserved for financial sovereignty. This includes contributions to retirement accounts, building an emergency fund, and making extra payments on debt principal beyond the minimums. This money does not leave your possession to pay for a service. Instead, it is transferred from your current self to your future self. Treating this 20% as a fixed bill ensures that your wealth grows consistently, regardless of fluctuating monthly desires. Calculating your allocation. To implement this framework, you must work with precise numbers rather than estimates. Use your most recent pay stubs or bank statements to determine your exact monthly net income. This is the baseline from which all percentages are derived. Identify your net baseline. Look at the total deposits into your accounts over the last 30 days. If you have automatic deductions for a 401k or HSA, add those back in for a moment to see your true net, or simply use the cash you receive if you prefer to count the retirement contributions as part of your 20% future bucket. For most people, using the final take-home number is the simplest starting point. Audit existing expenses. List every recurring expense and variable purchase from the last month. Assign each item a label: need, want, or future. Be honest during this process. A gym membership is a want. High-speed internet for a remote worker is a need. Once labeled, sum the totals for each category. Execute the percentage math, divide your category totals by your total net income. For example, if you earn $5,000 a month and your rent, groceries, and utilities total to $3,000, your needs category is at 60%. This exceeds the recommended 50%. This calculation reveals exactly where your capital is leaking and which areas require adjustment to meet the 50-30-20 standard. Identify necessary spending shifts. If your current spending does not align with the 50-30-20 ratio, you must make deliberate adjustments. Most people find their needs or wants disproportionately high, which systematically starves the future bucket. The needs compression. When your needs exceed 50%, you have a structural problem. This usually stems from too much house or too much car. While you cannot change a mortgage overnight, you can audit smaller needs. You might switch to insurance providers for a lower rate, reduce utility consumption, or shop at lower cost grocery stores. This goal is to bring the total cost of living down to the level that allows the other 50% of your income to be used productively. The wants audit. If your wants exceed 30%, you are prioritizing current comfort over future security. This is often the easiest category to fix, but the hardest to maintain emotionally. Look for ghost expenses, like subscriptions you do not use or daily habits that have become invisible. Reducing this category does not mean eliminating joy. It means choosing the joys that provide the most value while staying within the 30% boundary. Prioritizing the 20%. If you are currently putting 0 or 5% toward your future, the shift must be immediately. Finance professionals suggest paying yourself first. This means as soon as your paycheck arrives, move 20% into savings or investment accounts before you pay for wants or even some needs. This forces you to live on the remaining 80%, and if the 80% is not enough to cover your needs, you must return to the needs compression step and find ways to lower that overhead. We're going to go over a case study, the mid-career pivot. Consider a professional earning $6,000 net per month. Currently, they spend 3.5K on high-end apartment and car, about 50%, and $2,000 on lifestyle, dining and travel, 33%, and 500 on basic savings account, around 9%. By applying the framework, they realize they are future poor. To correct this, they don't necessarily have to move out of their apartment immediately. They just need to start by cutting their wants from 2,000 to 1,500. This 500 shift immediately doubles their future allocation to $1,000, upping it up to 16%. To reach the full 20%, 1,200, they look at their needs. By shopping for cheaper car insurance or reducing their grocery bill by 200, they hit the target. The result is a balanced life where they still get to enjoy 1,500 of fun money while securing 1,200 every month for wealth building goals. Practical implementation steps. Transitioning to this framework requires a change in how you react with your bank accounts. It's not enough to know the percentages. You must build a system that enforces them. Separate your accounts. Use different bank accounts for different buckets. You might have one account for fixed needs, where your mortgage and utilities are paid, and a separate spending account for your wants. When the spending account is empty, your wants for the month are over. Automate the future. Set up an automatic transfer for your 20% to occur on the day you get paid. If the money is gone before you have a chance to spend it, you will naturally adjust your lifestyle to fit the remaining cash. Monthly review. At the end of every month, check your actual spending against your 50-30-20 goal. Life is a variable. Some months, your needs will spike due to car repair. In those months, your wants must decrease to compensate, keeping your future 20% intact. Income increases. When you receive a raise or a bonus, apply the framework to the new money immediately. This prevents lifestyle inflation, which we will cover in a future lesson, by ensuring that 20% of every new dollar earned is automatically diverted into your net worth. The 50-30-20 framework is a benchmark, not a law. For those with high debt, the 20% future bucket might be entirely focused on debt repayment. For those with very high incomes, the needs might only consume 20%, allowing the future bucket to expand to 50% or more. The objective is to establish a baseline that prevents you from living paycheck to paycheck and ensures that your capital is working as hard as you are.